Hello. Hi everyone. I hope you can all see this. My name is Stephen Miller. I'm the head of training, but there's a lot of training to be had, so I'm not going to waste anyone's time because you'll get to know me over time, and now is not the time. I'm looking forward to meeting everyone, though. Thank you very much. Um, We're just gonna go through here. You're gonna get your understanding. I would definitely recommend taking probably some sort of notes. Even if you don't think that's how you learn best, it'd probably just be helpful to get a baseline understanding of this, because these terms will come up frequently. Thank you. Welcome to, we've changed our name since the past, but Recap Analyst Training Super Day. Excel shortcuts. Here we go. 1 second. Sorry about that. Uh, Here we go. This is just a link to Wall Street Prep. They have a nice list of Excel shortcuts here they're going to be using. I can go over them in person and maybe a little bit hard to learn over Zoom. Just general rules are if you have a question, feel free to ask. Obviously, this is a recording and that can't work that way, but when we do get in person, do not be afraid to ask. We will gladly show you. Quick industry overview. So their classification of residential versus commercial real estate. So residential is anything with 4 doors or 4 units or less, and commercial is basically everything else. It's a simple working definition of real estate types: office, retail, industrial, multifamily. So apartment complexes, hospitality, and a couple niches are data centers. Those are huge now, especially in Northern Virginia. Self-storage, mostly college towns, unsurprisingly, and outside of cities. There's actually a formula for how to calculate self-storage needs based on population. I think it's distance from a city. Car washes as well. Real estate classes, we'll get into those a little bit later. A, B, and C, of course, A being the best. So industry overview, quick look at the past 2025 year. The commercial real estate market capitalization was 25.8 trillion roughly, and estimated 2029 will be at 28.16 trillion. Our CAGR, or our compounded annual growth rate, is sitting at 2.2%. Some of our major players, you can see everyone on the right, a couple of big names. It's all right if you don't know any of them, or if you don't know any of these words mean. Again, we're going to teach you, you're going to learn, you're going to understand. Um, so developers, Prologis and the Simon Property Group, those are the top two logos. Big developers, we'll get into what a developer is later if you don't know what it is now, but it's what it sounds like. They either start from the ground up or they just develop something further along. Brokerage, we have CBRE, I'm sure you've heard of them, JLL, Cushman and Wakefield. Private equity, Blackstone, definitely heard of them. Brookfield Asset Management, Starwood Capital Group, and some real estate investment trusts, Prologis again, American Tower, and Public Storage. So jobs in commercial real estate. So on the acquisition side, acquisitions are the process of purchasing properties for investment or development involving due diligence, negotiations, and closing. And then asset management is ongoing management to maximize property value. This includes things like budgeting, tenant relations, and maintaining physical condition. Physical asset management, that is, of course. Some key organizations are the National Institution of Real Estate Investment Trusts and the National Association of Real Estate Investment Fiduciaries. A couple of the key players in the commercial real estate industry. So banks, JP Morgan, Morgan Stanley, Goldman Sachs. I'm sure you've all heard of them. And REITs, or I'm going to start calling them REITs now, real estate investment trusts. Vornado, SL Green, Avalon Bay, Arcstone, UDR. And some private equity firms, Blackstone, Starwood, Angelo Gordon. I'm sure you're starting to understand. So jobs in commercial real estate, we talked about this a couple seconds ago, but development involves the creation or renovation of properties through acquisition, financing, design, construction, and management to increase value and meet user needs. We will actually be underwriting a development at some point this semester. Even if you're not on the team that does it, you'll be seeing the presentation at the end of it. We have also had a couple of networking calls with a couple different developers, which will be something to look forward to. And then one of our managers, Brady, is worked for a development company, Garrett, this past summer. So Brady's basically our development guy, but it's a great way to create value. And Grid development is a good place to learn from as well because you're learning every single part of the process, and the actual physical creation of the asset as well. A couple places for more information are the Urban Land Institute and the National Association of Industrial and Office Properties. Some key players are Lennar, Toll Brothers, and K. Hovnanian. Commercial, another aspect of commercial. Key players for development are Prologis, JBG Companies, Hines, Liberty Property Trust, and related companies. We've had one of the people we heard talk about development came from Related down in Miami. It's a booming market right now. Investment banking, I'm sure we heard of it. In my opinion, it's kind of overrated, but nonetheless, investment banking involves advising real estate companies and developers on financial strategies, assist with the underwriting and sale of securities such as bonds and real estate investment trusts. You help clients raise capital, find financing, determine that financing is also healthy, and structure these complex financial transactions. We'll get into obviously structuring when we get to the physical model. Just trying to keep things brief, and helpful for our introduction today. Connects capital seekers with capital providers. I mean, yeah, that's how funding works, and then analyzes the capital stack, depending about basically that all these things in parentheses, JV equity, preferred equity, senior debt, and mezzanine debt are different ways to finance a deal or a potential investment. Some factors we consider are the asset type, the risk profile, the investment horizon, the physical location of the asset, and cash flow integrity, meaning how likely and stable are those cash flows to continue. So investment bankers provide advisory services such as creating budgets, proposing waterfall distributions, and performing market and feasibility analyses. Sorry. Key banks, JLL, Goldman Sachs, Morgan Stanley, Barclays, just to name a few. So we have jobs in commercial real estate. Lending, analyze market trends, perform tenant and income expense review evaluation. Fannie Mae, H2 Capital, Instar Financial, and really any commercial bank is going to be a place of lending. Obviously, these massive multi-million-dollar deals, most people don't have that kind of cash sitting around, so people look for lenders to invest in or to help them finance their deals. Research analysts analyze public real estate capital markets, the macro environment, and public real estate companies, and advise REITs and institutional investors on capital allocations. Technical heavy. I'm sure maybe you've heard of CoStar. A few of us will learn, hopefully most of us will learn the technicals behind CoStar. It's we've referred to it as Zillow on steroids, but it's a very, very helpful piece of software for us real estate analysts. So brokerage and leasing. They represent buyers, sellers, owners, or tenants in negotiations. You can see the National Association of Realtors for information regarding single family, and the Society of Industrial and Office Realtors for information regarding commercial real estate. The usual big heads in there: CBRE, JLL, Cushman and Wakefield, Marcus and Millichap. So every corporation has real estate needs, work on-site analysis, leasing, property management. You can see the Cornet Global for more information. Retailer, this refers to retailers in any company with multiple offices and business locations. You can see how there's a lot of demand for that. Appraisal estimates the value of property. See the Appraisal Institute for more information. Those are all hopefully pretty self-explanatory. Industry language. So this would probably be the most helpful time to start taking some notes. Get into some of the things. If it doesn't make any sense, all right, it's okay. It'll make a lot more sense when you have actual numbers to look at and when you're calculating these things for yourself. Okay, so some of the financial metrics we're going to be referring to: NOI, net operating income. Hopefully we all know what that is. I don't think you make it this far if you didn't know what it was. So it's our income after operating expenses before debt, service, and taxes. NOI is I don't want to say it's the end all metric for commercial real estate, but obviously because it's right after operating expenses, you actually have a fairly good idea of how much your property is making before debt and taxes. Because, not to say that there are ways to get around both of those, but net operating number, net NOI is the number you want. Or cap rate, short for capitalization rate. I've never heard anyone call it that. It's called the cap rate. It's your NOI divided by your property value, and you use this to assess your returns. There's no general rule for higher is better, lower. For higher or lower is better. The usual varies on a per asset type basis. We'll get into that a little bit later on. You'll see IRR. Hopefully we know what this is. We'll be taking any accounting courses. So our internal rate of return. It's the annualized return accounting for time value of money, which means it takes into consideration time value of money, or the idea that $1 today is worth more than $1 tomorrow because it can be invested. Um, you will also get numbers for all these statistics. Basically, we're going to have a graph at the end that shows you, depending on the asset type, what a healthy number is for each of these fields. So cash on cash return is your annual pre-tax cash flow divided by your initial cash investment, and your debt service coverage ratio is your NOI divided by your debt service. So what your annual payment on your debt is each each reporting period. So it measures your ability to cover loan payments. Hopefully that makes sense. That one kind of sounds complicated, but it's a very helpful ratio. It gives you an idea of how well you're covering your debts, as implied by the name debt service coverage ratio. So your loan to value is your loan amount divided by your appraised property value. So if you're not buying a property with a loan, the other chunk is equity. Um, just an idea. So loan to value is just giving you an idea of how much of what amount of your purchase price or your appraised property value is going to be bought through equity. Ooh, whoops, too many. Perfect. Okay, so deal structure and acquisition. I would say the last slide are the most common words, but these are so important to know. So LOI is your letter of intent. It's a non-binding offer outlining basic terms of a deal. Your PSA is your purchase and sale agreement. This one is legally binding, unlike the LOI. Underwriting, this is what we're going to learn how to do. If you don't know how to do it, hopefully it'll make sense. It will make sense, not hopefully, sorry. So your financial analysis of a deal to assess risk and returns. Your due diligence is your investigation into a property's financials, physical condition, leases, etc. Earnest money, deposit to demonstrate the seriousness of an offer. It's called earnest because you actually mean it. And then escrow, if you've heard that word before, it just refers to the neutral third party that holds funds and documents until conditions stipulated in the contract are met. So some lending terms, your bridge loan, it's a short-term loan to essentially bridge the time periods if you need some sort of amount of financing. Permanent financing is what you go with long-term. Your long-term loan placed after stabilization, that is where we get our cash, not cash on cash, but that is where like the debt service coverage ratio, the debt service that you have each period with your permanent financing. You wouldn't really worry about that with your shorter term bridge loans. Interest only, in our model, we have an interest only loan. For a time period you're only paying off interest. It kind of hurts when you are paying that, you're only paying interest and you're not getting down the principal, which means you're paying a lot. But they're common and you got to do what you got to do to get money. So loan with no principal repayment for a set period of time, and your amortization is gradual loan repayment over time. Maybe if you've taken some higher level courses, you're familiar with amortization, but it's not hard to get your head around, even if you have no clue what I'm talking about right now. And then recourse versus non-recourse. Recourse loans allow lenders to go after the borrower's assets. So I'm going to take a sip of water. All right, so leasing occupation, your gross leasable area is your total rentable space in a property. So let's say we all live in commons. That would just mean your dorm room would be the gross leasable area. You can't lease, common areas or elevator shafts or stairwells or anything like that. Your occupancy rate is always expressed as a percentage, so it's a percent of total space. This isn't on a square foot basis. This is on a units basis. So occupied units versus total units available for lease. Your vacancy rate is the percent of space and not leased. Your tenant improvements are custom build outs for a new tenant space. So just think renovations. And your triple net lease or NNN. So when the tenant pays rent, property taxes, insurance, and maintenance on the unit that they live out of, or the unit that they rent, sorry. And then CAM or common area maintenance are fees for shared maintenance, parking lots, lobbies, etc. So Liberty, you pay for anywhere you can pay for a parking parking sticker. You can think about it as that way. That's kind of a CAM or a fee for shared space maintenance. So industry terms, valuation in market terms, market rent is the rent achievable in current market conditions. You'll see that on the pro forma, basically as a top line of, how much money can we be bringing in strictly off of revenue from this property. Replacement cost is cost to rebuild the property today. Appraisal, third-party opinion of property value, stabilized property, property that has reached target occupancy/income levels. Again, you'll see that later on, but your goal is to get is for your property to stabilize. We have a couple ratios when we reach stabilization. Like yield to cost. We'll see them later. I won't go into them now. Absorption rate, and it's the rate at which available space is leased in a market or that open space is being absorbed by someone looking to purchase it or rent it. MSA is a metropolitan statistical area. We're getting to some geographic terms now. So just a regional market with a core urban area of 50K plus people used for demographic and economic data aggregation. So aggregation just means to put it all together. Primary market, high demand, large MSAs like New York City, LA, Chicago, low risk and lower yield. Secondary market, mid-sized MSAs like Charlotte, Nashville, or Orlando, moderate risk and return. And then tertiary market, the smaller MSAs with limited liquidity, higher yields, higher risk. Trade area is the geographic area from which a property draws the majority of its tenants/customers. And your opportunity zone, a designated census tract offering tax benefits for investment. So we're going to go over just quick asset types really quickly. Real quick, office. I'm not sure how educated we are in recent happenings of the real estate market, but we were kind of laughing when this slide was first shown back in the fall to the first-time analysts because office space was not nearly as promising back then as it was now. Like there were major talks of offices getting turned into multifamily apartments like there are in New York City right now. But office is kind of making a little bit of a comeback right now, even though most of those leases or some of those leases are short term. Someone brought that up in the interview, I forget. But anyways, just to give you an idea of the market trend. So they're flagship assets for many real estate investors, often large and high profile due to prime downtown or suburban locations. If you can think of the new JP Morgan I don't know if it's headquarters, the new JP Morgan office in New York City. It's an absolute behemoth of a building. Other prominent buildings I'm sure you can think of. Returns are sensitive to economic conditions, high variability based on market cycles, high operating costs. Vacancies can significantly reduce profitability as well. And of course, these perform very well during economic booms. Other office types, central business district located in the city's core area, classified by quality and location. Class A would be modern, well located, high quality architecture. Class B, older, smaller, fewer amenities, and less ideal locations. C would just be whatever's left. Classification is relative to the city. Class A in Denver may be Class B in San Francisco. So it's relative, meaning there's no set universal standards. It's really more of a not that it's going to be 33%, 33%, like they're not going to be even thirds across the board, but it's possible, again, for a different property type to be a different class, depending on the city that it's in. Downturn is flight to quality. Class A retains tenants. Boom. Class B and C appeal to price-sensitive tenants. Makes sense. Suburban, located outside the urban core. That's what suburban means. Typically smaller, found in office parks with shared amenities. So multifamily, think about your traditional apartment complex, offers the most stable returns across economic cycles. Housing remains a constant need, and high occupancy even in normal markets. Minimal impact from tenant loss, and large tenant base spreads risk. Large tenant base meaning everyone needs an apartment, and there's also a lot of different tenants. Contrast, single tenant loss and other property types can significantly affect returns. More multifamily types, the suburban garden targets middle income tenants seeking proximity to the city. So think of like things on metro lines. Hopefully we're going to talk a little bit more about Northern Virginia commercial real estate properties. They just redid their metro. It's a lot of cities where being on a metro is a good thing and an investment worthy detail for some properties. So range from upscale developments with lifestyle malls to simpler homes. High rise, located in urban areas, housing hundreds of families, desirable locations and premium designs lead to high rental rates. Developers generate income primarily from rents. Mid-rise, less desirable than high rises, typically on city outskirts, generates income from rents, but to a lesser extent. Retail, demand for retail space, driven by factors like location, visibility, population density, growth, and income levels. Best performance in growing economies with high retail sales growth. Types of retail properties, strip centers are the smallest, community retail centers are medium-sized, and then power centers are larger, focused on big box retailers. And regional malls are the largest, offering a wide variety of stores. Behind the image is the King of Prussia Mall. I think it's in southeastern Pennsylvania, if anyone's from there. We have the anchor stores, often include grocery stores or large department stores. Surrounding smaller stores benefit from the anchor's foot traffic. Industrial properties, often seen as a staple investment for real estate investors, require smaller investments, less management, and lower operating costs compared to office and retail properties. So a couple types are heavy manufacturing. There's going to be customized and tenant-specific buildings. Light assembly, I mean, it's a massive warehouse. Sorry, combines warehouse, office, and assembly space, often multi-tenanted and easily reconfigurable. You can imagine what the inside of a warehouse looks like. It's definitely more easily reconfigurable than it would be to turn an office into a multifamily complex. So a warehouse primarily used for storing and shipping goods from manufacturers to consumers. You can see in this beautiful AI-generated image all the trucks pulled up on the side for bringing and shipping goods out to customers. Hotel and hospitality. Hotel types defined by services, amenities, and operating brands. You know them: Holiday Inn, Hilton, Marriott, and main hotel types: full service, limited service, and extended stay. Obviously, full service is like, I guess you could say, the nicest. Offers extensive amenities. Limited service, a little bit less, and then extended stay for longer stays that's considered to be a week or more with a couple less services. Single family condos. A condo is an individually owned unit within larger developments, high rises, marinas, housing developments. The condo board manages common areas, and then the freestanding homes, iconic single unit properties, can be purchased as investment properties similar to multifamily buildings. So speaking of some niche and non-traditional asset classes, senior living, if you've heard the Runkin Pratt Garage, it's actually named after a senior living home. I believe it's off Timberlake. So growing demand due to aging populations in developed nations, many facilities are located outside urban areas to reduce development costs. Competitive pricing is maintained through convenience and accessibility. Self-storage serves as a placeholder for future development, especially in urban markets, generates income to cover taxes while waiting for land value appreciation or zoning changes, offers real estate investors flexibility in project timing. Theme parks typically located in rural areas with low land costs, but close to cities for market access. You can think of Hershey Park, for example. It's kind of in the middle of nowhere, but it's not too far from Harrisburg. I'm kind of blanking on, I guess in New Jersey we have like Six Flags. That's not too far from Philly or Trenton or anything, but it's also kind of out in the middle of nowhere where land is cheap. Obviously, theme parks involve a lot of land, and I'm pretty sure we can all piece together this part. So a couple more cell towers, real estate investment focused on land for cell towers, increasing demand due to the growing digital and wireless world. And so now it's a good time to get in on cell towers. Probably 20 years ago was an even better time though. Land value rises as the need for cell tower increases. Lumber slash forest, niche real estate requiring specialty, knowledge, and labor involves purchasing large forested areas, cutting down trees for lumber production, profitable for experienced investors. You have to know what you're doing. We've never talked about looking into lumber and forest because it's definitely a niche field. But if anyone's interested, maybe come talk to me and we can look into buying a forest. I'm definitely down for that. Some data centers. Obviously, hopefully, we've heard a lot more about those, about the AI world and the need to power all that technology. So, specialized facilities for housing servers, storage devices, and network equipment, similar to warehouses, but designed for computer servers, operated and valued differently from most other property types. I don't know if people know this, but data centers' electric bills are absolutely crazy. Obviously, they're running computers at full storage, but I believe that actually just cooling them is the most expensive part. Massive industrial fans. Those are really cool as well. I'd love to see us underwrite maybe one or two of those this coming semester. So niche non-traditional asset classes, property technology. So it's the application of information technology and platform economics to the real estate industry. Prop tech companies offer tech upgrades for all stages of real estate development, investment, and operation, provide venture capital-like returns and increased liquidity through public markets. We've manufactured housing, built it in factories, and transported to plots of lands. The plots of land, fast-growing, non-traditional asset class with recent large transactions as non-manufactured housing just gets so expensive. Why not try a manufactured home? Increasing institutional interest, expanding to other asset classes. Life sciences, real estate designed for healthcare and medical advancements, rapid growth, especially post-COVID, with increased investments in the healthcare industry, requires higher tenant improvements and quality standards, higher upfront costs, but offset by high rent relative to other property types. So I talked earlier about how we're hopefully going to get a view on for real estate types and the investment classification, and what a normal range would look like. You can see the cap rate, the equity multiple, cap rate, the equity multiple, the yield on cost, and the IRR, depending on the investment classification and the real estate type. This will be helpful then to either screenshot or pause the video and write all these down, or take a snippet of this image and paste it onto an Excel workbook, whatever you think is going to help you remember it. And then the CRE analyst, I follow him on LinkedIn. Lucas put me onto this guy. You guys should all follow him. He posts stuff very helpful, relevant. He also keeps it pretty concise, and he's a consistent poster as well. This chart is from 2015. You can see on the bottom, it breaks it down by industry type, and then the investment classification: core, core plus, value add, and opportunistic. The surprising part is this looks like it's 20 from 2015, so it's 11 years old now, but it looks pretty similar to today. And speaking of today, that's all I have for you today. I hope this was palatable and bearable, and I'm looking forward to some in-person trading with you guys. Stephen Miller signing off. Thank you guys very much.